I will let you go ahead and present our last type of insurance that we want to cover today, which is term insurance.
All righty. Thank you very much, Keisha. And I got to say, go Saints, right? Even though we're not not looking so good this early in the season. But, man, this is a phenomenal opportunity that you guys have put together, this platform. So thank you to you, Keisha, and Linda for the group, man. I do find value in the group, not just on insurance, but all topics. So, and I think that's definitely needed, specifically in our community, you know, in these times, especially. And so I'll try to be as brief as I can today. Hopefully we have some questions. And also a great job to Jalinda and man, what's my man? I am drawing a blank. Chad, apologize. Great job because at the end of the day, guys, when it comes to insurance, some insurance beats no insurance, right? So at the end of the day, and there's a lot of options. And you know, I have my flavor that I'll be talking with you on, but man, at the end of the day, some is better than none. So make sure you get some if you don't have any, all right? As you see here, just a little bit about myself. As Keisha mentioned, I've actually been in the financial industry for 25 years now. It doesn't seem like that. I had no intentions of actually working in the financial industry. Thought I was going to be a computer programmer, but started, you know, got my licenses and began with this same company for 25 years ago, part-time. I now have my own branch location with over 40 agents. And we do business in about 9 different states right now. Next slide. You got it, Keisha?
Yes.
Okay.
Is that where you want me at?
It hasn't moved on my screen, so I don't know.
Has it moved on everyone else's screen?
No, I think you have to scroll down.
Yeah, just scroll it down, the slide down, or I don't know.
I can see it on mine, scrolling down.
If not, if I can, I don't know if I have the share control, I can pull it up on my end.
Yep, let me make you the host right quick, and then you can take it over.
Okay, let me. Gotta love technology, right?
Absolutely. At its finest.
All right, so I think I have control now. Can you? Okay. So just a little bit about my company. Yeah. Let's see. There we go. A little bit about the company that we represent. We are a leading provider. We're the largest financial services company in North America, and the company itself has over 135,000 licensed representatives throughout the United States, Canada, Puerto Rico, and we've been in business for since 1977. So over 43 years. We're not just an insurance company. We're actually a full service diversified firm that can help in all different areas. I know my topic that I'm going to basically stick to today is life insurance, but just wanted to give a glimpse of who we are because we don't do any advertising. So some people may not necessarily be familiar with us, but we are a publicly traded company on the New York Stock Exchange and doing phenomenally well. And so when it comes to life insurance, in my opinion, is one of the pieces to the puzzle. And so when you're building a strong financial house, you want to obviously protect the source of that lifestyle is going to be the income. And so that's the foundation of building a full financial service, a financial game plan, is making sure that you have proper protection, because if you don't have the right foundation, no matter what type of emergencies come in, you can fail. And so we believe that, you know, it's a piece of the puzzle, life insurance, and we believe in term life insurance. What's the importance of life insurance? And we said, you know, a lot of people, unfortunately, either don't have insurance, life insurance, or they don't have enough. But they'll spend a lot of money on their car insurance. They'll spend a lot of money on their home insurance, or maybe even health insurance. But we say that you cannot afford not to have life insurance, right? And so let's get to how do you calculate your needs when it comes to life insurance? We use an acronym. That acronym is DIME, D-I-M-E. And so if you don't know how much you need, this is a quick way to determine how much you need. And so the first D stands for debt, D-E-A-T-H, and debt, D-E-B-T. And so when it comes to debt, you want to calculate the type of funeral that you expect to have. You know, some people, just want to be cremated, very, very small service. Other people, as Keisha mentioned, we've been from New Orleans, they have what we call second lines. It's a big old parade. And so you want to know how much that's going to cost. The average funeral nowadays costs about maybe $12,000 to $15,000 just for an average one. Now you can do it less, or you can definitely do it more as well. And so then you want to factor in any debt that you are wanting to pay off. And your debt might be car loans, student loans, credit card, medical bills, anything like that. And so you can get an idea how much coverage you would need just off of that first letter, D. Then the I would be how much income would your survivors basically need in the event your income stopped when you die, right? And so you can quickly multiply whatever amount you feel that you want to leave them, or you feel that they need. So you can multiply the amount of the desired monthly income times 10. So for an example, if you have $2,000 a month that you want to still leave behind to take care of whatever expenses, you just multiply that times 10, that would give you 200,000. The M stands for mortgage payoff. Now, again, this is based on what your needs are and what you want to do for the family or the survivors, right? Some people say, hey, you know what, my spouse, if it's a spouse, they can continue to pay their mortgage with their income, Others say, hey, I want a debt-free home, if something were to happen to me. And so it just depends on the balance of that house. Now, here's something that I would suggest, and whenever someone does factor in paying off the house, now, if someone does pass, that would probably be the last thing that I would recommend them do. I would not want to see them take $200,000 and hand it over to the mortgage company. Now, I would rather have them take that $200,000 and put it into a guaranteed investment, and then take monthly income from that guaranteed investment to pay the mortgage loan. And we can talk about that a little later if you have questions on that. And then the E would be education fund. And so you might have kids that you want to pay for college in the event that you die. And I'm only talking about in the event of your debt at this point. And so, and you have to determine what type of college, how many years, how many kids. Some parents may only want to get the kid through the first year. If I die, I want to take care of the first year of college for my kids. Or if you want to take care of the whole 4 years, and if you have 2 or 3 or 4 kids, you have to factor those in. But once you get those things calculated, that's what I call your gross need of insurance. Then you would subtract maybe any assets that you might have, because at the end of the day, insurance is asset replacement. So if I die, I'm earning a certain income every year. If I die, my income stops. So I want my family to still have that certain lifestyle based on these calculations. And so whether I have that in insurance or if I have that same amount in my 401k, it's all accessible to my beneficiaries. So hopefully that makes sense. And so there's different types of life insurance. Once you've factored in or calculated how much you need, then you look at the options in getting it and filling that need. So some people choose to get group life insurance on their job. The only challenge with group insurance is that you're not necessarily in control of it. So if you do choose that option, know that, number one, it may not be portable, which means that when you change the job, you might not be able to take it with you. And if you are able to take it with you, it won't be at the same price because there's discounts. The other thing about group or work life insurance, I also urge my clients to get a copy of the actual policy every year, because usually there's some stipulations in there that sometimes would void the contract upon your death. I've seen some crazy cases, some of which required a person to be eligible to actually be at work. So I would encourage you to get a copy of your policy every year. And then the second option is cash value. And we heard from the two previous speakers of a few types of cash value insurance. And that's insurance that basically combines insurance and savings of some type. So it's a combination deal. And you have whole life, you got flexible premium, adjustable life, you got universal life, and it comes in a number of different names. And then you have term life insurance. And term life insurance is just insurance. So there's no savings element. There's no savings element involved. It is just insurance. And you have different types of term. You have what's called annual renewable term. We call it ART, right? Then you have something that's called level term, which basically means that from beginning to the end is going to stay the same amount. And then you have decreasing and increasing, which means that, hey, you might start at a certain point, but then over time the coverage decreases, or you might start at a certain point and over time the amount increases. And so you have to determine what's best for you. Now, I am of the opinion that term is best for probably 99% of the population. And so you have to buy the right type that you feel is best for you. Now, I said what I said based on this theory. And this is a theory when it comes to, say, total financial planning. It's called the theory of decreasing responsibility, because you have to ask yourself, what is the main reason for you needing insurance? And so with most people, they need insurance because they have young kids. They want to leave a legacy for, or leave, something to take care of them. They have debt, which a lot of people have a lot of debt, and they might have a mortgage. So if something were to happen to, say, John and Mary, and they have these responsibilities with no money saved, in savings accounts or retirement accounts or 401ks, that could leave their family totally devastated. So usually when you are younger, you need more insurance because of that situation. But over time, Keisha mentioned I have two boys. One is 11, one is 17. So obviously they're not working in their full-time careers right now. And so if something were to happen to me, I would need to leave something behind to take care of them. But over time, let's fast forward 10 years, right? One will then be 27 and one will be 21, and maybe even another 10 years. Well, one may be 37 and 31. Well, I probably won't need, we're speaking of need, I probably don't need to leave a lot of money behind to them to take care of them. See, right now, it's all on me for their food, clothes, and shelter. Well, 10 years from now, 20 years from now, it will not be all on me. It's going to be that shift is going to happen. So I won't be as responsible for taking care of their needs as time goes on. Therefore, my need for insurance is decreasing over time. And in the later years, maybe when I'm 50, or I'm almost 50 now, 2 more years, 1 more year. Maybe when I'm 60, 65, 70, I may not need any insurance at all. May not need. I might want it, but I may not need it. What's going to also happen during these next few years for most people is that because the kids are becoming less and less dependent, our expenses tend to go down. I don't have to buy shoes every 3 months. I don't have to buy clothes every 3 or 4 months. I don't have to feed them every, breakfast, lunch, and dinner. So then I'm able to save money a little bit more. And we all want to do that eventually so that we can live financially independent. And so, but it's in the early years where savings is the toughest because of the same reason. So over time, we will be able to increase our contributions to savings and also get better interest rates. So I'll touch on that for a second. And then over the many years, they say we better have money saved. But here's the thing. As you determine the amount of money that you need in insurance, and then you look at however much you might have in savings. So your beneficiaries do not care if they have to dig in your left pocket or your right pocket. They just want to have something to take care of them. But over time, The more you get in your savings, separate from your insurance, because term insurance does not have savings. I'm talking about in mutual funds, or IRAs, and 401ks, right? So the more that you accumulate separately, the less insurance you need. So let's say if you did the calculation, you might need $300,000 of insurance and you have zero in savings. Well, at some point you might have 100,000 in your savings, right? Retirement accounts and whatnot. Then you really don't need but 200,000 of insurance. That still leaves your beneficiary a total of 300,000. So hopefully that makes sense. And so when you have your assets, your savings built, then that also reduces the need of having insurance. And so quickly, I want to give you something that I found very valuable, man, in my early years, and it still kind of blows me away when I see it in this format. There's something it's a math rule. It's called a rule of 72. It talks about how does interest impacts your savings. And I know Delinda has posted this in the group a few times, but man, this is a very important rule when it comes to understanding your money and compounding. See, what I know is that most banks and savings accounts, they will not give you 1% interest. But I'm going to use 1% just for easy math's sake. See, if you put a penny in the bank today and the bank gives you 1%, it will take you 72 years for that penny to become 2 cents. And how do you calculate that is simply using the number 72, and you divide 72 by whatever the interest rate is, and the answer is the number of years it takes to double. So if you got 1%, 72 divided by 1 equals 72 years. And so in this example, it's showing you 10,000, but it doesn't matter if it was 1 penny or 10 million. If you get 3%, 72 divided by 3 equals 24. So your money would double every 24 years. Now I'll just fast forward over to 12%. 72 divided by 12 equals 6. So every 6 years, as you see on this slide, your money would double. But here's what is known. This is a fact. Inflation has averaged right at 3% over the past 50 years. So if your money is not earning 3%, then you're actually if you're getting less than 3%, you're actually losing. Your net is, it's a net loss. So it's a must that wherever you decide to save money, to keep pace, not even to grow your money, to keep pace, you have to get at least 3%. And there's some options to do so, right? And we're advocates of mutual funds for the average person. I love being in the stock market, but for most people, they don't have the time, the expertise, the knowledge, or the access to properly choose stocks. Yeah, you can pick a stock or two, but for a sound foundation on investing, I always say leave it to the expert and you don't have to worry about it. See, the S&P 500 has averaged over 10% throughout the life of the S&P. And so can 12% be given? Of course. There's bunches of mutual funds that have returned more than that. So let's talk about the cash value, right? What would you choose? If you had the option to choose Bank A or Bank B, what would you truly choose? And this kind of talks about, when we talk about the insurances that bundle, the first bank, it says rule number 1, when you make a deposit into this bank, they get to keep your deposits for the first 2 to 5 years. The second rule is that they will guarantee you a low interest rate, and that usually ranges from 1 to 4%. Rule number 3 is when you want your money, you have to borrow it. And when you borrow something, what happens? You must pay it back with interest, right? And usually the interest is somewhere between 4 and about 7% of your money, right? Rule number 4, you have to wait. They have the right to wait up to 6 months to give you your money when you do request it. Now, they won't necessarily keep it, but they can. It's in writing. And then number 5, they keep it when you die. See, most people would not choose to bank in a bank that works like that. Bank B, hey, your deposits are yours from day one. Your money is going to be invested. It's going to average somewhere between 9 and maybe 12% interest. And you never have to borrow your money. You just simply withdraw it when you need it. Whenever you need your money, they'll process it immediately, process the withdrawal immediately. And then whenever your person dies, the family gets the cash. And so when you look at comparing some of the insurances out there that bundle, the insurance, a lot of them have those flaws of bank A. But when you break it down, like I have for you, most people would choose to not go that route because they can see that it's more beneficial to separate insurance from savings. And so for us, we say there's three nevers. Never buy any kind of cash value or whole life insurance, including universal life. And I'm not trying to be controversial, but it's open discussion. We say number two, never buy insurance as an investment. So you get investments for investments. Insurance should be for insurance. And then never buy an insurance policy that pays dividends. Again, I know that's somewhat controversial based on the previous two speakers, but an insurance dividend is an overpayment of premium that they are returning to you. An investment dividend is a profit sharing. So when an insurance company gives a dividend, it's basically like a tax return. Like people get excited for getting a tax return, but really you basically overpaid your taxes during the year and they're just giving it back to you on April 1st. And so when it comes to life insurance dividends, that's basically what a dividend in life insurance is. Now, here's some experts that you may have heard of. Third party always mention those things. Susie Orman, people are familiar with Susie Orman. She says, in my opinion, there's only one kind of life insurance that makes sense for the vast majority of us, and that's term life insurance. Jane Bryant Quinn, term life insurance is pure protection, like fire insurance or auto insurance. Its sole function is to support the family if you die. You can buy the big policies or what your spouse and children needs. And so when you think about it, your car insurance doesn't have a savings plan. Your home insurance doesn't have a savings. Your health insurance doesn't have a savings. And so we think that life insurance should not have a savings as well. Now, I'm not saying don't save money. I'm just saying don't combine it. Most families are over premium and underinsured. See, the reality is that most people just don't have enough insurance in place. There was a statistic, I don't have it here in front of me, that said the average person is underinsured by over $200,000. And a part of the reason is that because when you don't buy proper, when you look at the cost of having those types of insurance, it costs a lot for those amounts, when they combine the savings elements. And so the industry average for say $1,000 of coverage is about $7.50. Our company is about $3.56. The average protection for face amount in the US is about $153,000. Well, because we do term life insurance, is about another 100,000 on there, right? 234,000. I'm coming to a close with the next couple of slides. And so I wanted to give like an example of what I'm speaking of. And so here's a average couple, 35 years old, John and Mary, they got $100,000 of say a whole life policy, cash value policy. And in this example, they'll pay $225 a month. And they'll do that, say for the next 35 years or 30 years. Now, over time, they're going to build up a cash value. Here's the challenge sometimes, and I won't just say all, I'll say most. Whole life insurance is that when a person dies, the company keeps the cash value. In a lot of those, I'll just say most, I won't say them all, but a lot of them. And so if John or Mary, they have $100,000 of coverage, no matter how much is in their cash value, if both of them die, their family would only get the 200 combined thousand, the company would keep the 76,000. Now, if they needed to access this money, they can access it, but again, they would have to borrow it, which means if you borrow it, you would have to pay it back with some interest, right? Now, if you die before paying it back, then they would then reduce the amount of coverage by the amount borrowed plus the interest and things of that nature. And so what we would say, instead of doing that, you do need insurance. You do need to save. But in our opinion, it's best to keep them separate. And so with the term insurance, the same couple could spend only $80 and get $250,000 of coverage. And so then that would leave a difference of $145 that they can choose to do whatever they want to with. But then they have two times more coverage, basically, right? Now, if they die at any given moment, and this is, say, a 35-year plan, just like the previous example, we have a term for 35 years. If they die at any given moment, the family would get $250,000. But if they did invest separately and they got a 9% return, which again, the S&P 500 has averaged 10%, then over that same period, they would accumulate in a separate account $265,000. And this could be a tax-deferred account, like an IRA, or a tax-deferred annuity of some sort, right? And so now, if they needed to get access to this money, they just simply if it's a tax-qualified account, then of course they have to wait until they're 59 and a half to be penalty-free. But if it's just a voluntary account, then they can make them withdraw at any time without any penalties. Now, they may have to pay taxes, but you have to pay taxes on any income, right? And so that's an option. And then if they just continue to invest the difference, as you see, the next 5 years, it would be $282,000 at age 70 for them. And so with that, guys, I'll just kind of leave it at that and open up for any questions about term life insurance or insurance in general. Thank you so much for your time.
Thank you so much, Errol, for that. Any questions for Errol?
Not a question, but thank you for breaking that down, Errol. I think this was really phenomenal, having the 3 different types broken down, the index, the whole, and the term. And, you know I could ask a million more questions on each policy, but Errol, thank you. Jalinda, thank you. And Chas, thank you so much. This is extremely informative and reinforces the importance of educating our community on the types, but the need for insurance. So thank you.
Awesome. I like that sweatshirt, by the way.
Hey, I can just drop me a text. I got you. That's my brand. I got you.
All right, cool.
Do I have to buy insurance to sell you a sweater? I'm just kidding.
Hey, we can work a deal. We can work a deal.
All righty. Well, thank you so much, Errol. I really appreciate all the information. If anyone have any questions for Errol that they were not able to ask, definitely feel free to put them in the group as we share